Hello, welcome to the Empower Series. For those of you who are new, my name is Clifton Johnson. I'm the founder of the Empower Series Incorporated, which is a 501c3 nonprofit organization brought to you by the generous donations of Comerica Bank, AE Media Group, and our viewers in the United States and around the world. So thank you for tuning in. If you want to find out more about the Empower Series, definitely check us out on our social media. We're on Facebook, Twitter, Instagram, LinkedIn. You're actually on YouTube right now, so definitely like us, share us, subscribe if you haven't subscribed. More importantly, you've got to tell somebody else about the Empower Series, because the only way people are going to find out about the Empower Series is if you share it with them. So don't keep us a secret. You can also go to our website, www.empowerseries.com. There you can find out more about how we deliver hope, inspiration, education. We connect you to the resources that will help you achieve your goals, whether it's personal goals, professional goals, or financial goals. There's a donate button in the top left-hand corner, so if you choose to donate, we would greatly appreciate that, but definitely stay connected with us. Nothing of significance can ever be done alone, and life is about building relationships. Today's program is about life insurance because September is National Life Insurance Awareness Month. And what the pandemic has taught us, many things, but one of the most important things is that life is fragile and things unexpectedly can happen. So our hope today is that this program will not only just educate you, but really inspire you to take some actions to solidify the security of your family. And so I want to share some statistics with you. So 36% of Americans say they plan on buying life insurance at some point this year. And 48% of millennials plan on buying life insurance. And that's critically important because what research has shown is that 42% of Americans will experience some kind of financial hardship within 6 months once the major wage earner passes away. And 25% will suffer some kind of financial hardship within a month's time. There's 102 million Americans that have some type of insurance gap. So again, our program, the intent of our program is to not only empower you, but to educate you on the value of life insurance and really inspire you to meet with a financial professional to really get an understanding of what life insurance is, do you need it, how do you assess it, and really secure the financial security of your family. Now, our guest today is a good friend of mine. His name is Carruthers. He's a financial advisor and chartered retirement planning counselor for Inclusive Wealth Management, which is a private wealth advisory firm, a practice actually of Ameriprise Financial Services, LLC. He's been in the business for 18 years. And Trey, welcome back to the Empower Series, man.
Thank you for having me. Thank you for having me.
Well, man, I first want to give you some love and appreciation because I know that you've had a long day of work,
Yeah.
right? You're on your front line helping people achieve their goals.
Yep.
But then you're taking time away from your family and really just to rejuvenate yourself. So the fact that you're investing your time with the Empower Series community, man, I have much appreciation and gratitude for that. So thank you.
Thank you. Thank you for having me.
For coming, man.
Yeah, thanks for having me.
Now, before we get started, I know we want to talk about a lot of stuff. We got to do a disclosure, though.
Okay.
So let me kind of read this to make sure I get it right.
Okay.
So the disclosure is the topics and information that we're going to discuss today in this program, the Empower Series, are for informational purposes only and is not intended to be and should not be construed as an offer to sell or a solicitation of an offer to buy any life insurance product, security, or financial instrument, or invest in any entity or investment strategy. The information shared should not be used to form the basis of any investment decision. Our discussion is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult with your own tax, legal, or accounting professional before you engage in any transaction. Done deal, period, drop the mic.
Got it covered, covered.
Right. So today, though, we're going to talk about some things, man.
Yes.
So I want to make sure that we cover some key questions that people who may not even know what life insurance is would have, but then also people who have an idea of what life insurance is, and they may be at one point didn't think they need it, now they think they do, or they might have a family now and they think they understand what life insurance is, but need to be educated because in this industry things change a lot. So I want to really cover and talk to you about how do you introduce this protection piece to someone who may not know what life insurance is, or feel like they don't need it, or if they do need it, how do they assess how much they need? What are the different types? Stuff like that. I just want you to guide us through it, as opposed to me telling you my own opinion about life insurance, right?
Understood.
So what are your thoughts about that?
So what to start with is the one thing, and we can't guarantee much in our profession, but the one thing we can guarantee is that we are going to die at a point in time.
Right.
And so when you look at life insurance, it is the one tool that we know that if we fund it and if we have it, that there will be a benefit to it. And it's also, life insurance is the most selfless investment you'll ever make, because you're not investing in yourself, you're investing in the future of someone else for the benefit of someone else. And so that's the foundation of life insurance. So am I willing to make a sacrifice on myself, knowing that it will pay off in the future? It's going to happen. We all only have the dash that we live, especially in the midst of a pandemic. So that's where I start with life insurance, just the basics of it's going to pay out. Are you willing to sacrifice for the benefit of your family, your spouse, your children? If you don't have children, it may be a niece, nephew. It may be for your parents. If you're charitably inclined, you could leave money to a charity. There are different benefits or beneficiaries of an insurance policy, but it's just a matter of investing in the future of someone else or in the future of another entity. You never know what it may be. Now, as far as the different types, we try to keep it simple. Two main types of insurance: term insurance, meaning that you pay a set premium for a set amount of time. So you may pay term insurance, you may pay a premium for 10 years, 20 years, or 30 years. There may be even some 1 or 5 year term policies. But that premium is set, and you get a set amount of life insurance, $100,000, $500,000, whatever it may be, for that term. All right. And then there's permanent insurance. Another word for permanent insurance could be cash value. Right. And there are several types of permanent insurance. But you pay a premium, traditionally a little bit higher than term insurance. But as long as you pay that premium, and as long as that permanent policy has cash value to cover the cost of insurance inside of it, then you will have insurance for your life. And so we can often outlive term policies, but permanent it simply means if it has premium, if you're paying premium, if it has cash value, you will have life insurance. So someone will benefit from the life insurance.
Okay, so we're going to back up a little bit before we even get into. We're going to definitely go back and get into more details about what term and permanent is.
Understood.
But I just, I think we were talking earlier about the fact that there's a lot of people passing away right now.
Yes.
Unexpectedly, and I share with you that as I get kind of emotional about this, my brother passed away in April of COVID, and it was really interesting because he was on the show, right, in August of 2019, sharing his story, and I finally got him to do that, and I'm always on him about, dude, you got your finances straight, he had just retired from a Sears, and so I wanted to make sure he had his own life insurance policy since he was losing his working life insurance. And so he never really shared that with me. I didn't know, right? Because I'm his little brother, right?
Understood.
But unfortunately, he got sick in March of 2020, and he passed away very quickly, right? And what was fascinating about that is in September of last year, so we interviewed in August, but in September he was working with a financial advisor in Waco, or an insurance agent, basically. And he had got permanent insurance. And so he knew the importance of that. And so what I want to talk about is, as you're engaging with people and they're meeting with you, most people are looking at, hey, I want to save a amount of money, want to invest and make all this money, but how do you back up and say, okay, let me introduce life insurance to you. So how do you define what life insurance is to someone who's don't even know what it is? Like our conversation is going to be, like, how would you talk to me as a client potentially? And I'm thinking, so what is life insurance?
Yes. So life insurance is an amount of money that an insurance company will provide you or provide your beneficiaries.
Right, because I'm not going to be around, right?
Yes. Life insurance as its basic form is a benefit that will be provided to your selected beneficiaries based on your ability to pay for it monthly, which is called a premium. And so as long as you pay that premium, whether it's term or permanent, like I mentioned, and your beneficiaries will receive a life insurance payout upon your death.
So this is where you say that the act of getting life insurance is a love act, because you're paying money into a policy that is not going to benefit you per se, because you're going to be gone, but it's going to benefit your beneficiaries, which could be an individual, or it could be a charity, it could be a church, whoever you define that to be. So it's a selfless act.
At its foundation. There are benefits to life insurance, particularly permanent, because it can build cash value, but at its foundation,
right. We'll get into that. Because the first thing, at least what I tell people, is like, if you're getting life insurance, it may have these secondary benefits of building wealth, but the foundational piece is that it provides a benefit to your beneficiaries.
Yes.
Right?
Yep.
Okay. And so when someone's meeting with you and they hear what that is, whether they're single and young and don't think they'll ever need this, or whether they're married with new kids, how do you then help someone determine if they need life insurance themselves?
Great question. Great question. So traditionally, with our younger single clients, we don't talk about it as much. Or the question comes down to: do you have someone in your life that you'd like to leave money to if you pass away or if you're gone? And so so even if you're single, that's where I talked about maybe a niece or a nephew. If the answer to that question is there isn't anyone, then there may not be a need for life insurance.
Right.
Of course, as people transition to where they have families, married, kids, responsibilities, they may own a business, then life insurance becomes important, because you're looking to replace yourself, or replace your income, or replace your worth over time. And so figuring out, is there someone that would benefit or that needs to benefit upon my untimely death, then that's a simple answer from it.
So there's a couple of things that I talk to people about. Number one, no one can tell you what your need is.
True.
So really, it's a matter of being asked questions and having people think about things that they haven't thought about.
True.
By putting some structured thought to something. But then I also say this. So I know I have bought a life insurance policy for my adult kids, because I know that they're young, they're trying to accumulate wealth. They don't see the value of life insurance now, but my hope is that when I'm gone, they would then see the value of these policies that I've gotten for them when they were young and healthy, right? But here's the other thing: even if someone's 18, they don't really have anybody, they don't see themselves getting married or whatever, I kind of ask, so at some point when you don't wake up, what do you think will happen? And I talk them through that. And basically it will be some loved one that would take the time away from their job. If they're in a different city, they may have to travel, take time off work. And they will basically have to just go through your stuff, which is work. And not to get into a lot of the details, we'll do something about estate planning later, but there is a cost involved for loved ones to handle your final remains and just the stuff that you're leaving behind.
Significant.
Yes. So there's some people who say, well, I don't really care about that, or my parents have enough money, my friends, whatever. But at some point, whether it's a final expense policy or a small amount that says, I want to make sure that whoever has to go through my stuff or take time off work to make certain decisions that weren't in their plans, I want to at least mitigate the financial impact of them doing that. And do you have conversations like that?
Yeah, true. I do. In realism, though, you're speaking from the wisdom of being a little bit more mature, and having children.
Were you trying to say I'm old?
So it's and I even think back to 18, 19. It's just
I wasn't thinking that either. Right?
It's just hard to correlate, because even at our age, particularly as men, we can believe that we're invincible. All right, and so. And that invincibility really doesn't start to deteriorate until maybe 30 plus, when it hurts to get out of bed. So I'm open to having a conversation, but to me it still starts with, is there someone, and we've provided insurance to younger clients, but it still came down to not the thought of what happens if you don't wake up, but more so, I have my little brother and my little sister, and I know that my parents won't be able to do anything if I'm gone.
Right,
I'm the
right.
first person to really make or earn wealth in my family. And so I know and I'm already helping take care of them. I'm sending money to my mama, I'm sending money to my daddy, things like that.
Yeah.
So in that space, yeah, you can definitely speak to a younger person because first generational wealth a lot of times becomes the dependent or everybody becomes a dependent of that person that's of first generation wealth.
Right, right.
And so everybody's leaning on them and just the responsibility of it. So that person can definitely insure their lives simply because if you take that cog out of it, you have a lot of other lives that fall apart, even though they're young.
Right.
But the same thing carries over to a primary breadwinner, a husband, or even a wife that may be stay at home.
Right.
Yeah, you're taking care of kids, but you're vitally important to the success of the family, the unit, and so that's irreplaceable. If someone's working and there's one spouse at home that's not working, think about what that working spouse would have to do if they lost a stay-at-home spouse.
Right.
It would change everything. They may have to quit a high-paying job, or they would have to hire a nanny. So there are various reasons that people don't think about. I guess to your premise, there's always a reason for life insurance.
Yeah.
But I still go back to the simplicity of we all will die.
Yeah.
There is no, with all of the different investment opportunities that are out there, there's still some questions or thoughts, there's some volatility. We're going to die. And so if you're investing in a fact, it's going to happen, and it's a selfless investment.
So what I like about this is that a lot of times people meet with you and they don't want to talk about it, right?
Yes.
They want to talk about investments, all this other stuff.
Of course.
At the end of the day, the real value that meeting with a professional does is asking questions that they would normally not be asked, and having them think through things. And at the end of the day, they still may decide that I don't need life insurance. But to have the thought process to confirm that, or to be asked something that says, oh, I never thought about that. Maybe I do need to do something else. But that's, like I said, very important to have foundationally. So what is life insurance? And then do I even need life insurance? Having this conversation. But then if there's a determination that there's a need for life insurance, before I get into or ask you questions about the different types, how do you then step them through? How do they determine how much they need?
Great question. So I try to keep it as simple as possible with clients, and depending on where they are in their season of life. So most of us have college debt now. Our college debt is huge. And so I ask the simple question of, you at least want to cover enough to take care of your liabilities if you pass away untimely. So you want to be able to cover all of your debts, whether it be credit card, car loans, student loans, whatever it may be. You want to at least have enough insurance to cover that. From there, you can look at what's called human life value. And so what will your earning potential be over time? And so if I'm 25 and I'm making $100,000 a year, then I know over the course of my working life, I'll easily bring in $2+ million, just easy math. If that's not affordable, then we may back that to say, okay, 10 times your earning, whatever your salary. So at least 10 times your earning potential or your salary, that is a good number to look at. So being precise about that is important because a lot of times clients or people will come in and ask questions about how much should I get? How much do I need? And so I try to, we got to at least cover our debts, human life value, but 10 times your earning potential is just a good foundational tool. One thing that does bother me, and I see it, and I've called it out, particularly in our community and with clients, is what I call the trap of first generational wealth. And what I see is the trap of the first generational wealth is I don't want to leave too much.
Oh, okay, gotcha.
And so I call that out and say, why would you say, why you want to leave inheritance for your children's children
Right,
goal.
right.
And so life insurance can help you do that. So there's no such thing as too much. I've seen people that didn't get anything, and I've seen people that got plentiful, and it's just a different lifestyle.
Yeah, so I can think about a few things that I want to go. I don't want to go too far ahead,
Understood.
but let's kind of back up because you first talked about kind of using a rule of thumb, like 10 times your annual salary, right? And then some life insurance companies will make sure that you're not over-insuring by getting like $1 million of
true.
life insurance and you only make $20,000 a year, right?
True.
So there's a rule of thumb of so many times your salary, and life insurance companies make sure that it's not too much, right? That's one thing. But the other way is to assess your needs. So like you mentioned, if you want to eliminate certain debts, like your mortgage, car, things of that nature, or if you want to put money away for your kids' education, that's one thing. And then replacing your income. So there's usually a worksheet. You can find them online, or you can talk to a professional, and they'll help you. They'll step you through it. And what I found is that the rule of thumb is pretty much meets almost your needs, right?
Yes.
When you think about it, right?
Yep. Fundamentally,
Yeah.
yes. Yep.
But I do want to say this though, because as I help people through that process, sometimes what I found for people who didn't have life insurance is that not all debts need to be paid by life insurance.
True.
So if you have some credit card debts or personal debts, in some cases those cannot be claimed against the estate, right? And they're unsecured loans or unsecured debt. And so it's important not only work with a financial professional, but also an attorney can help you with that too as well.
True.
In stepping it through and identifying what really is going to be an obligation of your estate versus debt that like a client told me once that, hey Clifton, I've realized that when I pass away, I'm going to owe somebody. I'm okay with that.
Because they can't come get it.
Like, good luck. Come on.
Can't come get it.
So you definitely there's a calculation of identifying how do I determine how much I need, and then who needs it. And you mentioned that if you're the major wage earner, you might think that your loss of income will equate to you getting a certain amount of life insurance. But then someone who doesn't make as much as you, or who is not making income outside of the home, but they're taking care of the home, right?
Yes.
And so really having that kind of discussion, because in some cases, you still may need the same amount, even though one person is not making money outside of the home. But to your point, if they were to pass away, that would really jeopardize the major wage earner and their ability to go out and make money.
Yeah.
Right?
Yeah. You really don't. The question in of itself is a very difficult question, because we do not know what will happen after we pass when that money is inherited.
Yeah.
And so we don't know how their life will be impacted. We don't know if the kids that we want to leave money for them to go to college, if they'll even go to college. But what life insurance does, and choosing a proper benefit does, it gives your beneficiary options.
Right.
And insurance in of itself provides options. If you don't have life insurance in place, you have very limited, your beneficiaries will have limited options.
Choices,
they'll have limited options. And so if you don't have life insurance in place, we might have to figure out how to even bury you. We might have to figure out how to bury you. We might have to sell property. We might have to move out. I mean, there are a lot of things. And so at its root, a life insurance benefit will provide options. And part of the selfless act is you want to provide as many options as possible.
Yeah, and so to your point, identifying how much you need today, right, is one amount. Let's say it's $1 million today. Your goal is not to pass away today, right?
No one.
So your goal is to live another, 60, 80, so many more years, right, to your 100. And so if you think that, okay, I got $1 million today, and I'm good, I don't need to go back and revisit. I don't need to go back and get more. I need less as I get older. It's like, dude, time value of money, right?
Good point.
60 years from now, hopefully, if you're 20 and you're in your 80s, that $1 million ain't going to be as worth what it was before, right? So talking about, how every year going through this conversation with a professional and assessing, your income is going up, so using the multiple of my income. Then also saying, what are my needs? As I get older, have kids, I may have a home, a bigger home. So this is not a one-time I'm good.
True.
This is like every time you meet with your financial advisor, your professional, you should be assessing your need for life insurance, right?
I would agree. At least annually, minimum.
Yeah,
You wanna at least review it annually to understand where it fits inside of the entire big picture.
Yeah.
Because as your assets grow, there may be instances where you could have less. I won't say where you need less, but you could have less in accomplishing the goals upon your death. But I don't know if I'd ever just encourage that you reduce because now I have more money.
Right.
Because like I said, you can't estimate what life will be like after you. You just can't.
Yeah, and we're going to get into the types, but before we even get there, that's another comment thing that you brought up. So you have a certain amount of life insurance that you need, and in the very beginning, you're really playing defense.
Yes.
It's like you want to make sure that if you were to pass away unexpectedly or suddenly, your family will make it to the mountaintop, or they'll be taken care of. However, if you don't pass away, which is what we want, right, and you live longer and you've accumulated assets, now life insurance is not really used as a defensive mechanism.
True.
It's used more as a financial vehicle to pass on wealth.
True.
And there's different reasons. So for someone to think today that I may not need life insurance in the future, is, we don't know what your goals are in the future yet. Your goal might be something totally different than the defensive mechanism, which is why you're getting it today.
True.
So don't be fixed on that.
It's very
right?
short-sighted, definitely, but it comes back also to just life experiences. And so as I get older, and for those that have been fortunate enough to see our parents who were very strict and stern and may have disciplined us a certain way, interact with grandchildren,
Right.
and see how they respond to grandchildren, to think that you wouldn't want to have life insurance for your grandchildren is just not true. So that love, that affection, and so leaving something, I've even had clients talk about skipping their children and leaving life insurance for the grandchildren.
Right.
And so, which makes sense. But then also there are tax advantages to life insurance as you get older, especially if you have a large amount of IRA assets that will be taxed. If you have non-spouse beneficiaries that are receiving that IRA asset, they're going to have to take that money out over a 10-year time frame.
Right.
And so that's going to increase their tax basis. Life insurance can help cover that tax basis. So there are different ways, different means to look at life insurance as you get older. But the main thing is just understand that there will always true selflessness. And I'll go back to that because there are those that just are internal and don't believe in life insurance. That's who they are. But true selflessness is there will always be someone, something, some entity that can benefit from your investment in the future. And the multiple on life insurance. So if I spend so many years paying a premium, let's say over time I may invest 50 years, $50,000, $100,000 in insurance. But if it pays $500,000 in the future or $1 million in the future, the return on that investment is really good.
Yeah.
Really good.
Yeah, much better than most investments, really, when you think about it. Okay, so now we understand what life insurance is. We kind of assessed our do we even need it based on our goals? We've gone through some kind of calculation to determine how much we need. And a lot of times when we're doing that, people want to fast forward. They want to say, well, how much is it going to cost me, right?
Yeah, of course.
It's like, no. There's a term that says, look, when you look at cost, cost is only an issue in the absence of value.
True.
So what I usually like to do is let's identify what your needs are without looking at how much things are going to cost, because a lot of that can be mitigated by the different types of life insurance, which we'll get to. So now let's say we identified a need, $1 million or whatever that is. Now it's a matter of let's go into how do we now cover that need. And then there's usually a combination of what you were talking about before, of permanent insurance and temporary insurance. So we're going to talk about permanent insurance later. Okay. Let's simply talk about and define for people what is temporary life insurance. How do you describe that for people?
Okay. So term life insurance is nothing more than you set a time frame for how long you want to be insured, whether 10, 20, 30 years, and you pay a set premium for that term that you select.
So it could be annual renewable 1 year. It could be 5, 10, 15, 20,
Yes.
sometimes even 30 years, right?
Yes, it can be.
Okay.
Yeah, as high as 30 years.
Okay.
Yep. And so as long as you pay that premium monthly, your family will, or your beneficiaries will receive that death benefit upon your untimely death.
So what are the benefits of having term life insurance?
Benefits of term life insurance traditionally, in comparison to other forms, inexpensive.
Premium-wise, right?
Premium-wise, yeah.
Okay.
The monthly payment is usually cheaper than a permanent policy.
For the amount of coverage.
For the amount of coverage,
Right,
yes.
okay.
That's really, and you can, because you can select the term, you can make it goal-based. And so if I'm a young father and I know based on my cash flow, based on what I can pay right now, I want to have coverage to where if I die anytime within the next 18 to 20 years, or I want to make sure that my children go to college. And so that term, I may just employ a term insurance policy to save money, to be able to pay this premium. If I die, then I know that that benefit goes to my children going to college. So I've seen clients use it to, they may get a boat, or they may get a new loan, a business loan, 10-year loan. And so I get a 10-year term policy to know that I'm covering, at least if something happens to me, that loan will be paid off upon my untimely death. So those are the benefits.
So if you have a specific period of time where you need coverage,
Yes.
that's cool. When you look at the amount of coverage versus the premium, that's usually less. So for people who are cash strapped,
Yes.
they don't want to spend that much on premium, but they need coverage.
Yes.
Also, some term policies are convertible.
Yes.
So you can get it for a period of time because you know you have a need, but then if your income's going to increase, you can then start converting some of that to permanent to last longer than the term.
True statement.
And what that does is it's based on your health and your age, usually your premiums.
Yes.
And so if you can lock in a term policy when you're younger and healthier relative than older, that's another benefit of a term policy, right?
That is true, yes.
Okay.
The ability to do what's called a term to perm conversion, where you are insured and you don't have to go back through underwriting again. One of the detriments of term insurance is that depending on when you get it, and that term runs out, if you still want some form of insurance, you may not be able to go through what's called medical underwriting.
Yeah.
As we get older, we run into certain issues: cholesterol, blood pressure, weight, restrictive height, whatever it may be. It becomes a little bit more difficult to get insurance. So yes, you can convert some term policies to permanent.
Yeah, so just to let you know, right? So I ran into that problem, actually.
Okay.
So personally, full disclosure here, so me as a financial advisor, I know the importance of life insurance, and I've got life insurance when I was younger, permanent and term, didn't really see the value of it. I really didn't understand life insurance until I got into this industry in 2004.
Okay.
Prior to that, I didn't really read a lot of the contracts. I just, okay, whatever. And so one of my insurance agent, Jackie Johnson, that was her name, right? When I came here to Dallas, she told me I wanted to get a lower premium.
Okay.
And I said, well, I'm not gonna get it now. I'm just gonna wait a year until I lose weight.
Wow.
And she said, Clifton, you will not lose weight.
Oh, wow.
And she was right, though,
Yeah.
right? And so what I did is I had to go ahead and go through underwriting the ending of the policy. And this is back when I was actually working at Ameriprise now.
Okay.
Come to find out, man, I found out through the underwriting process that I'm table rated.
Oh, wow.
And I was table rated D.
Oh, wow.
So let's talk about the underwriting process and what that means. Basically, they'll look at your medical records to see if there's any kind of medical issues to measure the risk. And you can either be above average and healthy, or average healthy, or kind of risky. Right?
True. Yeah, true. So
or if you smoke, that's another premium that's going to be added, right?
Yeah, smoker rates are definitely higher. So I don't want to speak in the place of an insurance underwriter by any stretch of the imagination, but for simplicity, you will be measured by basics when it comes to, are you insurable? So if I'm if I'm an insurance company, can I take a risk, on you and your health? And so, like we said, height, weight, blood and urine samples. Diabetes. Make sure if there's anything that stands out in your situation that would make us not want to give you life insurance, because the insurance companies won't do it if they think you're high risk.
Well, they would do it if you're high risk. They'll charge you for it, right?
Yes.
But then if you're above their range or their scale,
yes.
And so back to what I was saying, I found out that, and we've done this before, where we've quoted somebody a price, then it comes back table rated, and you go like, well, we got good news and bad news. At least you're insurable, right? Yeah. It's not like you're not insurable. But the premium is like 3 times more than what I quoted you.
True.
And then there's a value conversation or importance conversation about how important this is. And I know that at Ameriprise we would always say, so what they're basically saying is that your family has a greater chance of getting this payout.
Yeah. Sooner rather than later.
Right.
Yes.
So that being said, it's important to stay healthy.
Yes.
It's important to get insurance now versus later, because in most cases people don't get healthier as they get older.
That's true.
Right. And I've kind of found myself in that situation where I was paying 3 times more for a premium of policy than what I would have been paying if I was in better health. Right. The other thing, though, is people look at work insurance, because work insurance is a type of temporary policy.
True.
Because it's for a period of time, usually while you're employed.
True.
And so some people might feel that I can solve my need for life insurance with work insurance as opposed to buying a term policy. So talk a little bit about that. How do you deal with clients who are looking at work insurance?
So work life insurance policies are good policies for the simple fact that you're paying a group rate. And what a group rate means is everybody, the employees within that company, get a rate because of the number of employees that are on this life insurance rate band. And so you may be able to get a higher amount of term insurance or temporary insurance through your employer for a low monthly premium or a low monthly cost, because they're all kind of pooling you together. And that is a positive. And many times, depending on the amount of the death benefit, you may not even have to go through underwriting.
Right. So sometimes most employers usually give you a basic amount of coverage for nothing, like $150,000 for whatever, or 3 times your salary.
Your salary,
or something like that.
Yep, exactly.
But then if you want more, you can usually get 5 or more times your salary, but then you got to show proof of insurability. So then you have to go through some kind of underwriting process where they'll have somebody come out and take your blood, your urine, your weight, and then they might even request your medical records.
Yeah, your medical history, yes.
Yeah. So this is all called underwriting, and a lot of that is involved with whether you get a term policy or permanent policy to really assess what your cost is.
Yes.
Right.
Yes. So your underwriting results will determine, and we don't want to make it seem like the underwriting process is all negative too. So we may come back.
Could be good news, right?
It could be good news. You may be really healthy, and you can get what's called it could be preferred rating or a super preferred rating. It may be a little bit less than what was projected. So, but the underwriting process, the life insurance process, it will tell you where you stand from a health standpoint. And so you were talking about the work insurance. The other side of work insurance, though, is if you go through a point where you go through layoffs or unemployment, and that's all that you have, you can be in a space where you don't have life insurance.
Yeah, or I'll tell you, this is what happened with me when I went from JP Morgan Chase to, I think, USAA.
Okay.
Right? So I had adequate coverage outside of work for my need, and then I used the insurance at my employer for just icing on top of the cake, right? And I did a multiple of my income. But then when I moved, in order for me to get that multiple of my income, I had to go proof of insurability.
Oh, okay, yeah.
Dude, I was rejected.
Oh, wow.
I was like, what? So that's what that's like, okay? Man, you hate, these are stories to where we tell people this, right? Yeah. And I share this with you guys because, look, I'm in the industry, and it's happened to me. And so a lot of times we have clients that this has happened to.
Oh,
but when it happens to you personally, you go like, now I see, right? No, just because we're financial advisors doesn't mean that we're immune to being human.
Yes,
right?
Very true.
So that's important to know. So again, we should have a conversation about how much you need. Do not fast forward to how much it's going to cost, because you got to go through underwriting. We can address the cost with a combination of temporary insurance, which is more, I guess, easier on your pocketbook versus all permanent, because the other thing about temporary insurance that's not really that much of a positive is that we don't know when we're going to die.
Yeah.
And you might think you need life insurance for 10 years, 15 years or whatever, but come after that period of time, if you still need life insurance, you got to go through underwriting again, which is going to be higher.
Yep.
And if you pass away after that and you didn't get it because it was too high, then you have no insurance.
Yeah.
So the whole purpose of life insurance is to really have that when you pass away. And if you don't know when you're going to pass away, you got to realize that term insurance may not be solving your total life insurance need.
True. Very true.
Okay.
It's and unfortunately, the word insurance has a negative connotation for whatever reason.
Yeah.
So the scenario I gave earlier, if we were to just sit, if we're sitting across from each other, you're a client, and I say you love your family, and the response is, yeah, I love my family. Would you do anything for your family? Yeah, I'd do anything for them. Do you want to leave money for the family? Yeah, definitely. I say, okay, well, over the next 10, 15 years, let's set aside the scenario I gave. Let's set aside $50,000, $60,000, and when you die, they'll get $500,000. You want to do that? Yeah, I'll do that. That makes complete sense. Where can I do that? Life insurance.
Oh, no, man. Slow your roll. Back up, bro. You just crossed the line.
Yeah, exactly. And so it's, whether it's term or permanent insurance, it's just for whatever reason, insurance has a negative connotation.
Yeah.
And it's really unfortunate because it's, like I said, it's a selfless act, and so many people miss out on the benefit of it. So many families end up struggling because decision wasn't made properly. So.
Yeah. So before we get into the permanent insurance, looking at temporary insurance still, pros and cons. Anything else from a pro and con standpoint that you would say?
No, I can't think of anything else. It's low cost. Low cost. You can set the time, and then, like I said, the con of it is more times than not we outlive the term.
Yeah.
And so you need to have, if you're able to convert it from term to permanent, great. But just understand that we outlive the term. And also, I guess I'll address something too. The whole thought around buy term and invest the rest.
Yeah, people don't do that.
Yeah, it just rarely happens. You know, we buy term and we spend the rest. Or that's human nature. And so, and we're increasing our expenses. You likely need more insurance. So that would be what I say. Just understand what term is for, that it's going to fit into a space, literally. That's what it's called. And we are likely to outlive it.
And so speaking about that, one of the things that people have a perception is that whatever money I'm putting into this term policy is money that I'm throwing away. I disagree with that.
Okay.
Because you pay for car insurance.
Yes.
Do you throw away your money for car insurance? I don't think they have that same perspective. You pay car insurance to cover you in the event that you get into an accident.
True.
So it doesn't financially devastate you. But you wish not to get into an accident. So if you don't get into an accident, you're not like, man, I threw all this money into car insurance, and it's like, I'm not getting anything back from it.
Yeah.
So with life insurance term, it covers you for a period of time, and truly you're paying more for the cost and the risk of that insurance company covering you, which is like car insurance. So whatever amount you're paying into that term policy for 5, 10, 15 years, or 20 years, or whatever, to be upset because you're not getting anything else, you got coverage. Yeah. So if you actually passed away, your family would have got a big benefit.
Yes.
If you really that upset, why don't you imagine the alternative, right?
A lot of people don't look at it like that.
Yeah. So term, there's a lot more to be covered about term. Okay. The important thing for people to take away, though, is that this is a general conversation, just to increase the knowledge and the education. But you have to really sit down with a professional to get your needs to identify your needs for you, and customize a strategy and a plan that's going to cover your family and what you need.
Yeah, specific for you.
And so term is term. There's going to be some links down below to some public information that they can look at. But now let's talk about permanent insurance, which really, when you think about it, if we want to make sure that we're covered no matter when we pass away, whether it's sudden or we're living to 99 years old, then the true insurance is permanent insurance.
Yes.
But when you look at the cost of the permanent insurance for our needs, then you got to like, okay, how can we work something out?
Yes.
So talk about how do you introduce permanent insurance to people, the different types, and step people through that?
Yeah, so when we talk about permanent insurance, I guess I'll start with the types first before introduction. So the older permanent insurance was whole life.
Yeah.
So whole life, you paid a fixed premium and you got your cash value within it, got a fixed rate of return. All right, and then so we transitioned to universal life. Universal life, pretty fixed premium, but you still got a rate of return. So money market rate of return. And then there are variable universal life, and now we have index universal life, but they're all permanent policies. Okay. Variable allows you to invest in the market. Index allows you to invest in the indexes. Now,
So
I don't want to get too complex.
Let's talk about whole life policy.
Okay, whole life.
The basic, because the whole, and then there's going to be a series of other permanent insurance, and we're not going to go into a lot of detail.
Okay, we won't go there.
So whole life policy says this: I want to be covered for my entire life.
Yes.
So the insurance company says, well, okay, let's assume you're going to live to be 120 years old. Mm-hmm. I think I covered your entire life, right?
That's what they assume. Yes.
And then they said, okay, so how much do they need to collect now over a period of time to really make sure that they're covered?
Yes.
And they do a couple of things. They can say, well, let's say you're going to pay for 100 years. What do I need? And then they say, well, let's say if you don't want to pay for 100 years, you want to pay for until you're 60 or 65. That's a shorter period of time. Or you can get what's called paid up. I want to pay it up in 20 years. So what you first have with whole life policy is that it's going to cover you for your entire life. And then you may have different payment schedules if you want to pay for it all up front, or you can just pay it all at once, which we get into a MEC policy, all that other stuff.
Yeah.
We're not going to do that.
Yeah.
But let's say you want to pay it off in 20 years, and most people buy those type of policies for kids.
Yes.
Like a baby's born, you want to buy a whole life policy, kind of pay it up in 20 years, so by the time they're 21, they've got a permanent life insurance policy for their entire life before they got into some risky things and increased their health health insurance rate. So that's one type of permanent payment schedule. Or I want to pay until I'm 60 or 65, because when I'm retired, I don't want to make a premium payment.
True.
So then that payment is going to be, a little bit less than if you paid it off in 20 years. Or if you want the least amount of payment whatsoever, usually you want to say, well, let me pay for my entire life. So they'll schedule out for 100 years, right? And so you're always going to be making a payment. And it's going to be, and that payment is going to be based upon the amount that you get covered for, as well as your health condition, right? But at the end of the day, you can rest assured that if you make your payments, your beneficiary is going to get a paycheck, or it's going to be a paycheck. It's going to get a tax-free lump sum benefit amount, no matter when you pass away, right? Yeah. So that's like the basic of whole life. Would you add anything to that for whole life?
No, and that's the basic of permanent. I mean, that's the basic.
It's fixed, right?
It's the base. Whole life is fixed. You have somewhat similar term. You still have the cost of insurance. So the actual life insurance costs the same, whether it's permanent or term, whole life or different types. But your premium is here, and so your premium may be a little bit higher. And what makes permanent, aside from the insurance, is that gap between what you pay for the actual term, the actual life insurance, and your premium builds what's called a cash value.
There you go.
And
that's
so,
a good point.
and we can go through that now or later, or
it's kind of hard to go through that just talking though, right?
Yeah, it is. It's tough.
So
It's tough.
at the end of the
That's
day,
illustration I can give
you really need to talk to a professional. But a good way of saying it is this: when you look at a permanent policy and whatever that is, your actual risk or cost of insurance is low in the very beginning, but then that cost of insurance goes up higher because you have a chance of dying as you get older. And so what happens when you look at the difference between your cost of insurance and the amount that you're paying, let's say your cost of insurance is $10, but you're paying like $50. So that $40 is going into a pool that the insurance company is investing.
Yes.
Because at some point when your cost of insurance is greater than 40, then it's going to use that $40 that you've been paying for the early years to pay for that difference in premium. But all of that is fixed in a whole life policy. You can't change it.
Essentially in a universal life as well.
Yeah, okay. So the difference between a whole and then let's say a universal policy where you've got some flexibility. It's a little bit more flexible. What's the flexibility in a universal policy before we go into a variable universal?
Yeah, so a lot of the flexibility with universal is just in the premium that you can put into it. And so the cash value within it is still pretty much fixed.
Yeah.
But with universal policies, you can increase or put more premium in based on the projections of the insurance, and that should allow you to build more cash value than the old school or traditional whole life policy.
So the way I understand it then is if a whole policy is pretty much fixed.
Yep. That's a ceiling.
Whether it's 20, 65, or 100 years you're paying it off, you can't change it. You got to make the payments. If you stop, you lose the policy. But with a universal policy, more flexibility is involved. So that means you can put in more money up front.
Exactly.
Let's say, for example, if you wanted to modify a universal policy to where it didn't last to 120 years, you say, I only need a policy to 100, you might be able to make some modifications and put in a certain amount of money that will project that policy to last for a shorter period of time than 120 years. But with that being said, with that flexibility, comes responsibility.
Definitely.
So what I've seen is if you're going to get into a policy that's not a whole policy, but it has some variables, whether it's in a standard universal, indexed, or even a variable policy, it is really more important that you meet with a financial professional on a yearly basis and reproject how long your insurance policy will be used.
Definitely.
And so not getting into a lot of detail because we can only go so far with that. The intention of what we want to do is to stress the importance of meeting with a professional.
Yeah, you have to review it, and what I've witnessed in my practice is I have older clients that had old whole life policies or universal life policies, and as the cost of insurance has increased, they've paid the same premium, and it's eaten up that cash value.
Yeah,
and so you almost have to go back and reassess and ask, okay, how much can I pay in premium to maintain the cash value and really to maintain the policy? Because you'd hate to pay for a policy for 30, 35, 40 years and it lapse.
Yeah, so basically what you're saying is that this cash value that people see as a benefit in a permanent policy, some people say, well, this cash value is going to grow and I can use it for paying for my kids' education or my expenses for retirement when I get older.
Yeah.
So much of that is based upon how much money you put into that cash value early.
Yes.
And what most people do, or not most people, what I've seen some people do, is they don't fund these policies with enough money in their early years so that the policy doesn't last as long as they would like, or it doesn't have the growth. And so when kids are ready to go to college or when they're ready to retire, they don't have as much money in that cash value that they projected. And it's usually because they didn't fund it with enough money early, and they didn't meet with their financial advisor on a regular basis to make sure that that cash value was growing as anticipated.
True.
And so I go back to say, when you look at permanent policies, and if you just kind of do a generality, you have a whole life policy, which is pretty fixed and pretty simple. If you want to go someplace and not worry about meeting with your financial advisor every day or every year, and you just want to make a certain amount and know that your family's covered, then even though there's not that much flexibility, it's probably higher cost for a whole life policy. That might fit your need better if that's what your financial advisor, your insurance agent says it works for you. But if you want some more flexibility and growth, and usually if you need some tax benefits as well, you may want to talk about other types of policies that have these flexibilities in them or flexible features. But it's very important that if you have those flexibility,
you understand
that you have the responsibility of meeting, and you can't just put it in the corner and make your premium, and then 10, 15 years later you find out, what?
Yeah, definitely.
or if it's a variable policy, then you got the market changing all the time.
Yes.
So what the takeaway is that you have two types of policies, or when you come to permanent, you got the whole, variable, or universal with flexibility. Sitting down with someone to really make sure, when you look at your total need, how much can be covered with a term policy that's probably more financially feasible for young couples, and then how much should be covered with a permanent policy to ultimately ensure that no matter how long you live, your beneficiaries will get a check.
There'll be something when you die.
Yeah.
Yes.
Yeah. So tell me about so a couple of things.
Okay.
So people's needs are always going to change. So how do you really address? You have the conversation with someone, they identify the need, you give them a recommendation to get a combination of term insurance and permanent insurance, and when you meet with them on a regular basis, how do you kind of readdress and update their need and probably update their strategy?
Yes. So it comes down to goals. So annually we sit down with clients and assess what are the goals. So what are the long-term goals? What are the short-term goals? And so as your kids get older, or the goals or the need to leave may not be as high. And so that's when you have the conversation around insurance. But it comes down to assessing your goals. What's important to you? And what's important to you in your 20s is vastly different than in your 50s. What's important to you single is vastly different than when you're married.
Right.
What may have been important when you were married may be different than when you're divorced, or even one of the big things about reviewing annually is your beneficiary arrangement.
Yeah.
So how do you have your beneficiary set up if you do have life insurance policies? And life changes may change how you do your beneficiary. So there are multiple reasons. You should do a beneficiary review for your accounts annually anyway, because it's just your wishes change, your wants change, and it's worth reviewing.
So a couple of things, and we're kind of wrapping this up. I got a couple more questions for you. So it's very important for people to really see how life insurance need to fit within their total financial plan.
Okay.
That's important.
Good point.
But one of the things that I see, and I would agree with you, that I think what's overlooked for people of color in most cases, or definitely low to moderate income individuals, is the ability to use life insurance as that stepping stone to close the gap between the wealth, right? And so one of the things, and we're about financial literacy, so everything here is about education, knowing how to manage money, and I know that my daughter's 35, or will be 35. My son just turned 21, and I'm sharing with them my finances. I'm showing them how I budget. And it's kind of embarrassing when I show them my mistakes, right? Because I think, man, I should have had more, right?
Yeah.
But when I'm doing that, what I'm realizing is that, hey, when I pass away, you guys will be getting all that I've accomplished and acquired in life insurance.
Yes.
But what's important is that if you don't have financial literacy, if you're not managing this wealth that I'm giving you could be a curse.
Could be, yes.
Yes. And so one of the things we talk about is estate planning, and possibly making sure that if you're going to pass wealth on to minors or even adults who are not responsible, that you use trust and other types of estate planning vehicles that can ensure that the money that you're leaving behind can be used in a benefit for your beneficiaries.
Yeah.
So do you get into a conversation with your clients about that?
Yes, I'm actually going through updating my estate planning as we speak. So my youngest daughter just turned 18, so I don't need guardianship anymore.
Okay.
And so whatever is left, if unfortunately my wife and I passed away at the same time, would go to my daughters, and then they inherit all this wealth. And so I want to make sure that the proper legal documents are in place to protect them.
Yeah.
But I'll take it back to the initial thought around, is there a such thing as too much insurance? And so what I've learned in working with clients from all cultures is that poor money management is universal.
It does not discriminate.
Yeah, it's universal. And so there are those that are independently wealthy because they've had generation after generation after generation after generation of poor financial decisions, but life insurance or trust that take care of them. And so how you set up your life insurance, how you set up your legal documentation can care for family and family mistakes for years and years to come. So instead of having the mindset of, I don't want to leave too much so they can blow it, I want to leave enough to where I know they're going to, it's going to happen. It's human nature.
Yeah.
But then there's enough for the next generation, at least to be in a good position.
Yeah, so that's a good point. And I would tell you, I made a comment in the very beginning of this program that nothing of significance can ever be done alone. And if we want to create wealth and pass it on to multiple generations, you can't just do it yourself.
True.
Also, life is about building relationships. And we had talked about, even at our level, upscaling our relationships. And there's always people thinking at a higher level than us. That being said, it is important that people start to begin acquiring relationships with financial professionals. So whether that's your banker, whether that's the financial advisor that's in the bank, or whether that's a financial advisor that's like yourself, that is not necessarily in the bank model, but you have an advisory practice. Talking to people who you look up to and ask them if they're using financial advisors, right? So really building those relationships with professionals, whether it's a banker, financial advisor, life insurance agent, a tax person,
CPA,
an accountant, and an estate planner, legal person. And I've seen college students coming into the bank to have a conversation with me because it's free, right?
Okay. Yeah.
And they're just saying, look, my parents are still supporting me, but at some point I'm going to graduate and I'm going to start having money. I want to learn how to budget. I want to learn how to, what's this Roth IRA? What are retirement planning? So I would encourage people who are watching right now, no matter how old you are, if you do not have a relationship with a financial professional, to start at your bank. You bank somewhere, and just go in and start talking to somebody. If someone wants to follow up with you and have a conversation with you, how do they get in touch with you?
The best way to find us is you can Google my name, Trey Carruthers, or you can go to our website, inclusive-wealth.com, and that will take you directly to our website. We're also on Facebook, Inclusive Wealth, just Inclusive Wealth Management. We're on Twitter as well. So the great thing about social media, the internet, you can just type it in, Inclusive Wealth Management, or just my name, Trey Carruthers, and we can be found pretty easy. Phone number, all of the above. Send us an email. We'll get in contact with you.
And I would say, so some financial advisors have minimums. It's like, look, if you're not making a certain amount of money, I ain't got time for you, right? So I remember when I was at Ameriprise, I'm not going to mention the name, but
Understood.
But one of the guys told me, he said, Clifton, I know you love to help people, but at the end of the day, if people are not saving, you can't help them. We'll talk offline about who that was, right? But so my heart was, if someone's going to take an hour of their time to meet with me, I feel like I didn't work for Ameriprise or Chase, all these other firms. I worked for God, right? And so they got, that 1 hour of valuable advice that I would give someone, no matter what their net worth was.
You're gonna learn something.
Exactly, and from that meeting, you got value from it. Now it's about you putting it into action.
Exactly.
If you're going to come back and keep taking my time, you need to refer me to somebody who got some money.
That's how you pay me.
Right. Because you got somebody in your circle, right? So with you, I don't know if we want to get into your practice, but at the end of the day, I would say if someone's interested in working with any financial advisor, go out and work with them, meet with them. Usually that first meeting is not a cost.
Complimentary.
Yeah, it's complimentary. So there's no cost besides your investment of time. Definitely encourage doing that. And Trey, we can talk all day, right?
Yes.
Okay,
yeah,
but
we definitely
you got to get on there.
Important topic, man. It's an important topic.
And here, this is just the beginning. So definitely you can come back and watch this again. Don't let this be the last. This is about connecting you to resources. So there's going to be a lot of links on the bottom of this video. You've got Trey's information as well. But what would you say as we wrap this up? What would be one of the most important things that you would want people to walk away with when it comes to life insurance, given this is Life Insurance Awareness Month? And they should be dealing with this not just in September, but in every month of the year.
Great question. Great question. So I'll say this just personally. So taking the financial advice cape off, and I'll make the statement that life insurance is simply the most sound investment for generational wealth. What you invest in life insurance goes to the next generation, and they inherit that wealth tax-free. So they don't pay tax on the benefit from life insurance. And so that alone allows the proper transition. And so as we move forward and we hopefully become more and more selfless as a community, you definitely want to invest in the future, invest in your children, invest in your grandchildren, just invest in your community. So life insurance is the most efficient tool to do that.
Yeah, and It goes back to foundationally, right? So again, Trey, thank you, bro.
My pleasure. My pleasure. Thank you for having me.
I know that you dropped a lot of wisdom here. It's important that you just don't sit on it. You take action, and the action to take is to really go out and meet with somebody who's a professional who can tailor a strategy and help you identify your needs and your situation specifically. Because as we said again, this is just for informational purposes. We're not giving you customized advice on any insurance or investment product or any strategies without you talking to a professional to implement those strategies. So Trey, again, thank you, man. Forever indebted. And we'll have to have you come back and talk about some more stuff too.
Sounds good.
Thank you for taking the time to watch. I would tell you that you have invested the most valuable resource you have, which is your time. What we tell people at the Empower Series is that one of your most precious resources are your ideas. And by listening to our program today, you have thought of some ideas. Jot them down. And I would just say, don't let them collect dust. So an idea in motion will attract provision. I got that from another gentleman that I interviewed. He said a vision in motion will attract provision. So take action on these ideas. Connect with the Empower Series. Put a comment down below if you found something that was very valuable that you want to share with the community. Connect with the Empower Series and me if you need to get connected to another resource. Connect with Trey, but do not let this be the last time that we hear from you. Until we meet again, I would like you to be empowered and inspired to thrive. Thank you. Thank you for watching our Empower Series YouTube video. I really hope you enjoyed it. Remember to hit the subscribe button below, as well as the little button to be notified the next time we upload our video. Until then, stay connected with us on social media, Facebook, Twitter, Instagram, whatever your social media flavor is. Inspire the world to thrive. See you soon.